If you pour enough water, then both the cups get filled. But what if you overdo it? If you just keep pouring higher more and more, then you start losing more than you gain. That's exactly what a call ratio spread does. Hi, I'm Pranav VK, your options trading strategist here at Stockshaala by Kotak Securities. In this video, we are going to understand all about call ratio spreads. In the previous video, we understood what is a put ratio spread, and we also understood that is a bearish strategy. Whereas, now we are going to discuss call ratio spread, which is a bullish strategy. This strategy is created by buying one call option which is of the lower strike and selling two call options which is at a higher strike. For example, you're going to buy 19,400 call option and you're going to sell two of 19,500 call options. Similar to its counterpart, the put ratio spread, here as well, the sell options is going to give you a higher premium than how much you paid in the buy option. You gain significant profit only if the move is mildly bullish and not sharp move. So when exactly you have to execute a call ratio spread? When you are mildly bullish or moderately bullish on the underlying market, as well as your IV is very high. When these two conditions are met, you're going to make really good profits. But remember, the market should move only moderately and you should not blast in the upside. This strategy is not good when there is a breakout expected or when there is high volatility days. Now let's take a real market example along with premiums and also the payoff diagram so that you can understand the strategy very clearly. To start with, we're going to look at buying 19,400 call option by paying a premium of rupees 60 and selling two of 19,500 call option at rupees 40, which means we are receiving a total premium of 40 plus 40, that is 80, minus 60 rupees that we are paying. So this is a net credit of rupees 20. The maximum profit for this strategy comes from when the market ends at the higher strike. So in this case, it is 19,500. So if the market ends at 19,500, then this strategy is going to have the maximum profit. The break-even point for this strategy is given by the higher strike plus the difference in strikes minus the net credit. So in this case, the higher strike is 19,500 plus the difference in strikes is 500 minus 400, that is 100, minus the net credit of 20. So that is going to be 19,500 plus 80. So the break-even point is going to be 19,580. If Nifty starts moving beyond this point of 19,580, then there is going to be unlimited loss potential. And that is exactly why having stop loss even in this strategy is extremely crucial. Alternatively, with adjustments, you can also convert this strategy into a butterfly or a broken wing butterfly, which we will be covering in the upcoming videos. So let's summarize what we have learned so far. We understood that a call ratio spread is a bullish strategy compared to a put ratio spread, which was a bearish strategy. A call ratio spread is created by buying one lower strike call option as well as selling two higher strike call options. The maximum profit for this strategy comes when the underlying asset or Nifty ends at the highest strike. Always ensure that you are entering into this strategy only when you are moderately bullish and not expecting a huge blast on the upside. Remember that the maximum loss is unlimited, so having a stop loss or having adjustments is very crucial. So if you believe in a measured rally, then put ratio spread as well as call ratio spreads are the strategies to go for. But remember where to draw the line. Let me know in the comment section which strategy you like the most and make sure you share this with your friends. You're watching Stockshaala by Kotak Securities. I am Pranav VK and I'm going to see you in the next video.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.